Well, tech earnings set to kick off this week. Investor focus seems to be broadening beyond the big cap names. The Russell 2000 has been outperforming the S&P 500 over the last 6 months, driven by valuations and rate cut expectations. Our next guest thinks this trend will continue. Joining us now is Northwestern Mutual Wealth Management Chief Portfolio Manager Matt Stucky. Matt, great to have you with us.
Thanks for having me.
So you're into the Russell 2000 move. You think this is durable?
Well, it's certainly been overdue just in terms of how narrow markets have been the last 3 years. And just to put some context on that, from 2023 to 2025, between 20 and 30% of the S&P 500 constituents outperformed the aggregate overall S&P 500. That's historically narrow. Typically that's in the mid to upper 40s. And it's just really been a reflection of, the monetary policy environment where higher rates have hurt, certain segments of the economy, and the narrow parts of the economy, the AI infrastructure build out has really kind of been the source of growth. Now we're starting to get the other side of that, where we're seeing kind of rates come down and kind of more cyclical parts of the economy pick up. And, that's led to, earnings revisions starting to, improve across different sectors and different segments of the market, small cap included. And that's really kind of been the key catalyst for unlocking some of that value dislocation that's been building the last 3 years. And if we continue to get the emphasis for the Fed to continue its rate cutting posture, I think those revisions have room to run. And so, looking at kind of the raw fuel for continued small cap outperformance, that's what you want to see. You want to see consistent earnings revisions up, and that valuation spread between small and large continue to compress, and that's the recipe for outperformance.
Matt, I wonder about the interplay of this expectation for a reaccelerating economy, which is supposed to be what's taking earnings higher, and the reduction in the market's predicted number of rate cuts this year. We're down to below 2 cuts from here. Who knows if that'll be right, but that's where we stand, and whether, in fact, there'll be a yield response in treasuries that could offset some of these positive trends you're citing.
Yeah, I think that is the risk. And certainly, if you look through history, the reasons we get corrections is because rates move higher or unemployment moves higher. However, I think one thing that has been surprising to the downside over the last 5 months or so has been inflation. And if you're looking for a catalyst for potentially that pricing of 1 or 2 cuts priced into the forward curve for 2026, it would be if inflation comes into the downside. And one of the interesting areas that I've been watching the last few months is just the growing downside wedge between the daily Truflation data and the overall CPI year-on-year numbers. And, that was one of the first areas that we started to see and signal higher for inflation early in 2021. It was somewhat prescient in terms of that upside expectation for CPI as you looked forward, the next couple of years with CPI topping out at over 9%. And, if that was a precursor to the upside, maybe it's perhaps a precursor to the downside. And so, we look here and we say, certainly there has been a couple of years worth of rate cuts in the rearview mirror, and potentially inflation coming in a little bit softer than what a lot of market participants might be concerned about. That might be the catalyst for continued cuts from the Fed, alongside a new Fed incoming chair when Chair Powell's term is up.
In terms of the areas you like, Matt, it sounds like you like everything except for maybe mega cap stocks here in the United States. You want to go down the cap scale, mid and small caps. You like IG investment grade fixed income, as well as international stocks. Is your portfolio shifting away from big caps in the U.S.?
I don't necessarily want to say that we don't like mega cap tech. We certainly respect the quality profile of these businesses and the impressive earnings growth that they've delivered. But it is somewhat unusual to have the market as concentrated as what it is, and that just increases the risk profile if we were to get some disappointment there. A lot of these names are growing in terms of their correlation around the ongoing kind of build out of artificial intelligence. And maybe those companies that actually utilize the products that are being designed and built and disseminated by the Mag 7 names are kind of the next leg in the trade. Certainly the labor intensity of the small cap companies and the mid cap companies is higher than that of the mega cap tech companies. And so if this technology does unlock a lot of productivity, certainly the ones that are using these products to unlock the productivity seem to me to be where some of this earnings leverage might be if these are huge productivity enhancers over the next few years. And so I think there's reasons to be optimistic, while at the same time respecting the strong quality profile of what we see in mega cap tech.